Yes. So yesterday we learned about IIR, which is the first charging mechanism, and today we will do UTPR. Okay, under tax profits rule, and how to apply and what it means. What is the concept of this? How is this charging mechanism apply for Pillar Two, etc. So yes. Now, how does the UTPR work? Now, under tax payment rule is a backstop mechanism under globe. It applies when top-up tax on low-taxed income is not fully collected through the income inclusion rule. If you remember income inclusion rule that we discussed yesterday, you saw that it is through an inclusion ratio, correct? UPE would have to calculate its inclusion ratio, and the top-up tax to the extent of inclusion ratio would only be paid by the UPE through IIR, correct? Now, what about the remaining minority interest? Let's say I own 75% of another low tax LTCE. I would only pay 75% of its top up taxes. What about this 25% 25% remaining residual taxes? That is what is taxed using UTPR. Okay. So that, end of the day, there is 100%. Now, UTPR operates a little differently from IIR. Okay, IIR parent entity includes top-up tax in its own jurisdiction, correct? Now, UTPR top-up tax is collected in other jurisdictions where M&E group has operations through deduction denial or equivalent. Now, don't think about deduction denial or equivalent adjustment, but you have to understand that other constituent entities of the group, right? They would be paying UTPR. So 75 based on the inclusion rule, the parent, the UPE will pay, and based on the residual will be paid in proportion by other constituent entities, and that is UTPR. Okay, so when does UTPR apply? UTPR applies when there is a residual top-up tax not collected under IRR, correct? So if it is not 100% subsidiary or a constituent entity where the parent entity owns 100% of ownership interest, then of course there would be a residual top-up tax, right? So there are three instances when UTPR would trigger or when there would be a residual top-up tax. When are those? When there is no qualified IIR at UP level. So if UPE is not having a qualified IIR, then yes, there won't be any IIR. Of course, it will go to the IP. Now let's assume that the IP is also in a jurisdiction where there is no qualified IIR. It could happen, right? So IIR may not be implemented at all because they don't have a jurisdictional qualified status. In such a scenario, UTPR kicks in, and 100% of the residual, 100% of the top up tax becomes residual top up tax. Then you have to collect it, right? That's why there is UTPR. So when there is no qualified IAR at UP level, or there is a low taxed UP jurisdiction, even the UPE is a low tax jurisdiction where the ETR is below 15%, or if there is split ownership, like there are minority interest. Okay, UPE has a qualified IAR status, but its inclusion interest is not 100% or inclusion ratio is not 100%. Then also there could be residual top up taxes. So in case of these residual top up taxes is when UTPR kicks in. Is it clear? Okay. Well, how would UTPR be collected? So, see, it's always IIR which would be collected. Okay, IIR always has priority over UTPR, and UTPR only applies to the residual amount not taxed under IIR. Okay, so it would be like this. Let's say that the LTC's top up taxes 1 million. So let's say UPE has 80% inclusion ratio through IAR, how much they will collect? 1 million into 80%, which is 800,000 would be paid by the UP jurisdiction. So UTPR amount would be on the minority share or the residual amount, which is not taxed as per IAR. So while using UTPR, what you have to always understand is you have to apply IAR. IIR, what is the tax coming under IIR? Only after that you should apply UTPR. You should not apply UTPR before that. Okay. So this is something of a pitfall there. Now, how do you calculate UTPR? Now, I told you who is going to pay the UTPR? It is paid by other constituent entities. Correct? Now let's see how to calculate UTPR and how the calculation metrics will go. Now, first thing is you have to calculate UTPR top up tax amount, which is nothing but the top up tax amount not collected under IIA. Correct? Now, once you collect that, or like the formula is UTPR top up tax amount is nothing but total top up tax amount of all LTCs minus top up tax collected under IIR. Okay, you first find the residual amount, nothing but the untaxed portion. So let's say that AR is has a low tax subsidiary. The UP jurisdiction has a qualified IAR, but AR only owns 75%. So what happens? We given a numerical example also. So country X subsidiary's top up is 400,000 is their top up tax. Okay. Now AR's inclusion ratio is only 75%. So what is the top-up tax collected under IAR? It is 75% of 400,000, which is 300,000, and UTPR top-up tax amount would be 100,000. This is how, and how did I get 100,000? Total top-up tax of all low tax constituent entities minus top-up tax collected under IAR. That's how you determine what is the top-up tax for UTPR. Okay. Now, so like this 100,000 attributable to 25% minority interest not collected under IIR becomes subjected to UTPR. So it's very clear. So first step is to calculate if there is any untaxed portion of top up tax. That's why it's called an untaxed profit, okay, or undertaxed profit rule. Sorry. Now you have to identify UTPR jurisdiction. Now which constituent entity will collect which constituent entity will collect UTPR. For the constituent entities to collect UTPR, they should also have a qualified UTPR status. Okay, it is just like only those UPs having a qualified IIR status can do top up taxes. So or like pay top up taxes, just like the constituent entities, other constituent entities which will pay UTPR on the untaxed portion, they should have a qualified UTPR status. Okay, so UTPR top up tax is allocated to jurisdictions where M&E group has constituent entities and the jurisdiction has implemented a qualified UTPR. Okay, so those guys where there is a qualified UTPR and the group has a constituent entity there will pay the UTPR. Now this is just like there are few countries which have qualified UTPR status. UK, EU, Australia, Japan, South Korea, Canada, etc. would have a UTPR status there. Is it clear? Step 1 and step 2. Step 1 is identify or calculate the residual top up taxes, and you should apply it to be paid by constituent entities who have a qualified UTPR status. Okay? Yes or no? Step 1 and step 2. I saw some disturbance there. That's why I'm asking again. If it is not clear, then you will not understand. Right? Now, how would they pay it? Now, how would these constituent entities in other jurisdictions, which has a qualified UTPR status, pay this amount? What is the proportion of residual taxes that they will pay? So you have to calculate UTPR percentages for each jurisdiction. Now, how is it calculated? It is using a substance-based formula. Okay, which equally weigh two factors. What are these factors? So UTPR percentage is what is each constituent entity's employee factor into 50% plus tangible asset factor into 50%. Now don't ask me why there is a 50% number. What they are trying to do is they are just finding a mean or an average of their employee factor and tangible asset factor of each constituent entity. Now, what is an employee factor? Nothing but, let's say, of one constituent entity, how many employees are there in that jurisdiction divided by total number of employees in all UTPR jurisdictions. Okay. So you would find the employee factor. We will do an example, don't worry. And of course, the tangible asset factor is tangible assets in jurisdiction divided by total tangible assets in all UTPR jurisdictions. So you will find what is each constituent entity's employee factor and tangible asset factor. This is the formula to use. It's just basically they are dividing the top up tax allocation, the residual top up tax allocation, on the basis of average of their employee factor and tangible asset factor. So what they are essentially trying to do is those with better substance has to pay more taxes. Okay, it seems like that now. Those with good investment or better substance there, that means that they are doing more economic activity there. So they have to pay the untaxed profits in their constituent entity. Okay. Now, how do you find number of employees? I mean, employees in jurisdiction, it's just number of employees, head count, and tangible assets is just net book value of tangible assets. Okay. Property, plant, and equipment, and other tangible assets. You just take the now, again, you have to understand that this is tangible assets, so there won't be any goodwill, no financial assets, no other intangible assets will be. It's only tangible assets that you have to include. Okay, so that is how you would find the UTPR calculation. And let's do an example to understand, like, how this UTPR calculation is coming, because I have thrown at a lot of formulas with you. So let's understand. So let's understand this question. We will do it together. So let's say AR Group has a UTPR top up tax amount of EUR 100,000 to allocate. Okay, so they have already calculated the residual amount. It is UTPR top up tax amount, not total top up tax amount. So after IRR, 100,000 is still to be collected. The group has constituent entities in 4 jurisdictions with qualified UTPR. So they have this group has constituent entities in Germany, France, Netherlands, and Ireland, which already have qualified UTPR. The details are provided to you. Please provide UTPR calculation. So how will you do? What would be the step one? So let's take an Excel sheet. Okay. So first, what is the first step? First step is finding the, what was step one? Finding the residual taxes, correct? Now, what is the residual taxes here? After application of IIR, what is the residual taxes? Yeah, it is, just now says it is 100,000, absolutely, because the question has called UTPR. So in case if it is not given, then you have to calculate. So what is the top up tax? UTPR top up tax is 100,000. Okay. So let's kind of double underline that. Now, what is step two? What is that we have to do? Whether the constituent entities are in qualified UTPR jurisdiction, then only we will allocate, right? So now and the question has given that all 4 entities are in qualified UTPR jurisdiction. So the tax would be borne, this remaining residual tax will be borne by everyone, correct? Because they are all in qualified UTPR jurisdictions. Now, what is the third step? Or the next step is to find the employee factor, right? We have to find the employee factor for each jurisdiction. So let's find out. So let's do step two. Let's find the employee factor, right? So what are the countries involved? Germany, France, Netherlands, and Germany, France, Netherlands, and Ireland, right? So what are the number of employees? How many employees are there? 200, 150, 50, and 100, right? These many employees are there in this jurisdiction. So what would be the total? There is total of five. There is total of 500 employees, right? Total of 500 employees, and now we will find employee factor. What is employee factor? Employee factor is nothing but what is the employees here divided by total number of employees. Correct? How many? What is my employee factor on the basis of total number of employees? So it would be this divided by this, right? Correct? I will just make it into percentile terms for easy reference. Okay, this is my employee factor. Yes or no? I'm just did like 200 divided by 500 is 40, 150 divided by 500 is 30. So you find the employee factor for each jurisdiction. This is step number 2. Okay. Now what do we do? We have to also find, I'll just kind of copy this here. What is the next thing we will do? We will find the tangible assets factor, correct? How many tangible assets are there? So step 3 is we will find tangible asset factor of the same jurisdiction. What is the tangible assets? What is the tangible assets? So question says in euro millions. Okay. So there are like 25, 20, 10, and 5. So total there are like 60 million euros worth of assets, and we will find the tangible asset factor nothing but what is Germany's total tangible assets divided by total tangible assets in locations which have qualified UTPR status. Basically, we are dividing the whole thing. So it would be 42%. So if I kind of like drag also. Yeah. Yes. So nothing but 25 divided by 60 into 100 is 42. 20 divided by 60 into 100 is 33. We find the tangible asset factor. Correct. Now I told you the UTPR share is decided by the UTPR factor or UTPR percentage, which is nothing but what is step 4? Let's calculate UTPR percentage. UTPR percentages for each jurisdiction. Okay. I'll just quickly copy paste the whole thing. Yeah, this is the jurisdiction. What is the employee factor? What is the employee factor? We have already calculated here, right? So I can just go and take this, right? So and what is the this factor is tangible asset factor. I'm just copying from the earlier workings. This is my tangible asset factor. Now we have to calculate what UTPR percentage. I told you UTPR percentage is nothing but an average of both of them, right? So it would be, let's stick to the formula, employee factor into 50% plus tangible asset factor into 50%, What you will get? You will get the UTPR percentage. Right? This is going to be the UTPR percentage. What I did, I calculated employee factor and tangible asset factor, and I took an average of that. Now, if that is going to be the UTPR percent. Now, what is the step four? Step four is allocation of. Now, let's allocate. Step four is allocation of UTPR. So, let's take the UTPR percentage. What is the UTPR percentage for Germany? We have calculated here, right? So I'll just do two so that it's yeah. And what is the untaxed UTPR top up tax? It is 100,000. So that I will divide. It's not tip, it's top. That I will divide. So I will just multiply this with this, and this I will, right? Now this is a now. So see that 100,000 I have allocated to all these jurisdictions by the means of the UTPR percentage. How did I calculate UTPR percentage? By multiplying employee factor and tangible asset factor. How do I get tangible asset factor? By taking the total tangible assets of all locations which have a qualified UTPR status. By taking, let's say that if Germany has 25, total is 60, we will just take what is the proportion of tangible assets and proportion of. Is this clear? This is very simple, right? This is how that untaxed residual globe income is divided into other constituent entities. But what you have to be very careful is it should be having a qualified UTPR status. Then only you can take. So this would be the workings which you can prepare, in case like, you need also. So it's pretty simple. Basically, UTPR is all about allocation of that untaxed profit to other constituent entities which have a qualified UTPR status. Is this clear? Is there any doubts? Let's take a moment at this time and ask if there is any issues in understanding. Yes or no? Okay, fantastic. So this is UTPR. Now there are few, how is UTPR collected? Okay, I understand that there is going to be, UTPR, but how are these jurisdictions going to collect the UTPR? I told you, like, there are two methods. One method is denial of deduction. So what they do is this UTPR amount, right? I mean, which is allocated to them, which we calculated, that would be denied as a deduction in their domestic tax returns. Okay, so jurisdiction denies a tax deduction to the local constituent entity, increasing the taxable income and generating additional tax equal to the UTPR amount. So there would be UTPR disallowance which happens. Now, how do you calculate? It is just UTPR allocation. So this is their tax, right? I mean, end of the day, this is untaxed. This is tax. So this tax divided by the local rate of each country would give you the amount which has to be deducted from their uh, tax returns. Did you get understand what they're doing? They're denying the deduction as a means of collecting the UTPR. Okay. Now you understand why they are doing divided by local tax rate? Because this is a tax amount. Now this is the tax I want to collect. So in order to kind of find the deduction amount, I have to divide it by the effective local tax rate. Getting it? Then only I'll get the deduction amount. No. Okay. Or the second method is an equivalent adjustment, which is basically the same. So some countries, what they do is instead of doing a deduction, because end of the day, again, there would be losses for that constituent entity, etc. So what they do is they applies an adjustment that achieves the same result as deduction denial. Example, like, they will actually tax it as a direct tax. You have to pay UTPR, there would be a direct tax charge, or it would be as a deemed income and it would be included. Instead of this deduction being disallowed, they will add it as an income. So either way, is possible. So how UTPR is collected is based on the domestic UTPR regulation of each entity. They are allowed and the model rules to do all these three methods, like, either denial of deduction or an equivalent adjustment by means of a direct charge or a deemed income inclusion. Yes or no? Yeah, fantastic. Now, this is very important. So there is something called UTPR carve out rule also. Now let's go to this question. And let's see if, let's say, Germany has around 40% of UTPR, right? Out of the total residual UTPR or residual tax, Germany has to now pay. Germany, the constituent entity in Germany, has to pay 40.83%. Now let's understand if Germany is having a loss. Okay, it is having a loss. Even if you deny an deduction and all, still it what does not come into the tax bracket. So Germany from that constituent entity cannot get that tax back, right? So that means again almost 40% of the untaxed UTPR top up tax is not coming into taxation again. Did you understand what I mean to say? If no, I would repeat that again. So what I meant to say is, let's say out of the total untaxed, globe income, how much is Germany has to pay? How much does Germany has to pay? Tell me in chat. 40.83%. So basically, like, 40,000 euros, right? Now, what happens is, let's say there are two methods by which they are collecting UTPR. What is that? Denial of deduction and income inclusion. Now, let's assume that Germany has, even though they have employees and assets, they have not done any business. Their revenue is zero, right? And they have a huge losses. Even if you include this UTPR and all, I won't collect any taxes. Even if I include this 40,000 as an income include, sorry, as a deduction denial or income inclusion, I would not collect any taxes, right? My effective tax rate is 0%. In such a situation, what happens is 40%, the lion's share would be untaxed again. So in order to avoid that, there is a carve out mechanism. Now, what does it mean? A jurisdiction is excluded from the UTPR allocation if in the prior year the UTPR top up tax allocated to that jurisdiction did not result in an actual cash expense. Okay. Now, what does it mean? So let's say that your UTPR allocation resulted in a tax expense, then you remain in the pool. If in the last year it did not result in UTPR, it did not result in a cash expense. Like this year, while this allocation is done, Germany did not pay because of their domestic tax rules or because of their, their loss, their financial position. If they are not paying, then what happens is this particular entity next year will be removed. Even though it has a qualified UTPR status, this would be removed from the pool, and this 100,000 will be distributed among only these three, so that there is no revenue loss due to domestic tax fluctuations. Getting it? This is called UTPR carve. So UTPR allocation result in a cash tax expense, then you will remain in the pool. But UTPR allocation did not result in a cash tax expense in the last year, and your UTPR percentage would be zero for the next year. Okay, your UTPR would be 0%, and the 100,000 would be segregated. Only these three entities would be taken for calculation. Okay. so that they, it would be adjusted now. Getting it? So that you don't end up paying. So this carve out does not apply if all UTPR jurisdictions would have a UTPR percentage zero. At least one jurisdiction to remain in the pool. That's okay. But why this matters? Because some jurisdiction may not be able to collect UTPR through their domestic law mechanisms. The carve out ensures that UTPR is allocated to jurisdictions that can actually collect it. So in order to avoid revenue loss due to domestic tax law mechanisms, what they have told us, if in the current year you're not paying that in cash, or like, there is no cash tax expense that's happening to you, you're having a carry forward or you're doing something else, then boss, you are excluded from the pool for the next year, so that the collection remains strong. Understanding the concept of this? Yeah, they have tried really hard to make sure that you don't escape any taxes. They have closed all the loopholes. Yes or no? Did you understand UTPR carve out rule, why it is there? It's just to avoid revenue loss. Okay. Thank you, Melly. Now, there is a UTPR safe harbor also. It's just transitional, just for in case if they ask, I just, so during the transitional period. Now there is a transitional period in which UTPR does not apply. Just like something called small business relief would not apply for 24 to 26 or the first 3 years. There is a transitional. So why transitional? Because this is a new law which is coming in. So we are transitioning into the Pillar 2 guidelines. So while this transition is happening, there is a safe harbor provided. Okay. During the transitional period, UTPR does not apply to the UPE jurisdiction if that jurisdiction has a corporate tax of at least 20%. Now, if the UPE jurisdiction has a rate of corporate tax rate of at least 20%, then even if they are, a low tax constituent entity, UTPR does not avail to them. So the transition period is only from till 31st December 2020. So any year beginning before, on or before 31st December, 2 years ending before 31 December 2020. So just for your first year, the transition period. First year, you don't have to pay UTPR in the parent company jurisdiction, in the UPE jurisdiction. If UPE jurisdiction has a tax rate of at least 20%. Okay. So for most M&E groups, no UTPR applies to the UP jurisdiction during the transition period. So if you have if they have a tax rate of more than 25%, and if that is the UPE, then there you can add a safe harbor. Now let's understand this with a practical example. Let's say that the headquarters is in or the UPE is in UAE. Okay, and the constituent entities are in Germany, France, etc. Now UP itself does not have a qualified IIR status, right? And the tax rate is 9%. So UTP, the constituent entities will collect the tax of UTPR for the untaxed portion from the parent entity also, if it does not have a qualified IR status or if it is falling behind. Now, that UPE taxes is kind of like, kept on hold for the first year. That is expired. That is only till 31st December 26, sorry. So, that is kept on hold for the first year because what their logic is, UP might be earning so much of profit. So first, let's kind of not do that, and later on, maybe because of some economic fluctuation or something, the UPE is not having to pay that effective tax rate, but after that it will definitely come. Now that is why they have only included those jurisdictions which has a corporate tax of at least 20%. So first year they might be kind of like, some problem. So after that, definitely, like, we will tax it, but in the first year we will not be taxing the UP. Getting it? If it is an LTC. Now, after transition, the safe harbor no longer applies. UTPR may apply to UPE jurisdictions regardless of their statutory rate. Okay, if they are an LTCE. But on the first year, we will only look at the statutory rate. And see, the rate is 20%. And if they have kind of paid less than 15%, that means it's maybe a one off thing. Because a UP can't kind of like, being the person who receives all the dividend and all the revenue there. Maybe. So first year we will exempt you, from the next year it would be taxed. Just a matter to keep in the back of your head, nothing much. And yes, now I told you that UTPR has to be collected. Now there is something called QDMTT also, which is qualified domestic minimum top up taxes. Now in case if qualified domestic minimum taxes come, how will the hierarchy be? Now in the hierarchy for implementation, I told you first level of charge is always IAR, and then after the residual there is UTPR. Now things will change a little bit if there is a QDMTT in those LTCs. Now if there is a minimum top up tax which is there, then QDMTT will take priority. Okay, the order of application will be first the low tax jurisdictions QDMTT will apply. After that, only IRR will be collected at parent level, and after that, UTPR only if residual limit. This would be the hierarchy which would be going forward. So, if since UAE has already implemented a QDMTT, the tax will the top up tax will go first to UAE, and if UAE has any residual portion, that is what is used for IRR. And if after IRR there is still a residual portion, that is what would be collected by UTPR. Is it clear how the hierarchy will go for each taxes? We'll learn about QDMTT later, but this is just for hierarchy. And of course, while applying UTPR, we'll take a moment here. Did you understand what is meant by UTPR? It is just allocation of residual taxes. It's a backstop mechanism so that we don't lose any taxes due to three reasons. Number one is the UP has no UP is not in a qualified jurisdiction, not neither is the IP. And let's say that the UP itself is a LTCE, it's taxed at less than 15%, or there is minority interest. Inclusion ratio is not full in while applying IAR that I can collect the 100% taxes. So in such a situation, UTPR is collected. UTPR, who pays UTPR? It would be other constituent entities in jurisdiction which have a qualified UTPR status, and it would be collected based on their employee factor and tangible asset factor. You have to see what would be the allocation of that amount into these. Now there is a carve out mechanism also. If I don't kind of actually pay that in cash, or there is no cash tax expense happening, but I'm just getting carry forward on other things, then I would be removed from the pool in the next year, so as to maintain constant revenue. And of course, there is a safe harbor for the first year in for only for the UPE jurisdiction if it has a tax rate of 20% or more. And of course, in case if there is QDMTT, the hierarchy is QDMTT first, then IAR, and then UTPR. Is it clear? Because we are kind of getting there where we are applying things now. We will only move forward if you understood what is UTPR and at least the basic understanding of how it is. If it ticks all the boxes, it's good, and later on you can read definitely, but it should tick all the boxes. You should not have any lingering doubt anywhere. Now, with that said, the common pitfalls while applying UTPR is number one, including non-UTPR. I told you you should only include jurisdictions with qualified UTPR in the allocation. Exclude entities in jurisdictions without UTPR legislation. Okay, that is one mistake everybody does if the constituent entity numbers are very big. Now, using the wrong asset base. Tangible asset means net book value of that property plant. Do not include intangibles, financial asset. Do not include costs. Do not include valued amount, etc. Do not include revalue, etc. Just take the net book value of the books for calculating the tangible asset factor. And don't forget the carve out. Okay, if last year there is no cash tax expense, and this year you have to exclude that entity from the pool. It is easier said than done. Once the numbers are big, these are the common mistakes which people do. And you should not ignore QDMTT priority. Always check if the low tax jurisdiction has QDMTT. If so, calculate UTPR only on the residual amount after QDMTT, and applying UTPR during transition period. During transition period, the UTPR safe harbor applies to jurisdictions with more than 20%. Don't calculate UTPR for UP jurisdictions in these years. In the transition years, don't calculate. Okay. What are the transition years? The years starting before 31st December 2025 and years ending till 31st December 2026. So during these years, there won't be any UTPR for the UPE. This is UTPR, my friends. Is it clear? Any doubts? If there are anything like, we can take it, later also. Yes. Okay. Denial of deduction. Absolutely. No problem. So let's say that, this is the, see, this is the percentage of taxes that Germany has to pay. And what is the tax that they have to pay? 40,833 is what is the allocated UTPR top up tax. Now you tell me, I have to collect this amount, right? So let's say, how do you collect this amount? By means of denial of deduction. Okay. Now let's say your profit is around 400,000 euros. Okay. And for simplicity's sake, let's take the tax rate as 25%. Okay. Now this is your domestic profit, right? Now I have to collect an additional 4833. How much do I have to add here? How much do I have to add with the profit to collect 4833? Or let's do it. So let's say the tax amount that I pay is 40,000 into 25%, which is yeah, 100,000 is the tax I pay. Now I don't want to collect 100,000. This is your domestic tax. I want to collect 140,000. How do I do that? How do I do that? So denial of deduction, what they do is, let's say you have identified a profit figure, right? Now, this profit is after, expenses and this, right? So now what I am doing is I am disallowing your deduction that was used to calculate this 400,000 to the extent of the taxes. So we will be doing, this is a tax I want to pay, divided by the tax rate. I will be disallowing the deduction. So this much I would be disallowing. So what will happen? What is my revised profit, or let's say adjusted profit, is this. Now, if I up the tax rate is 25%, and if I apply this 25%, the tax is going to be what? Now, did I collect 140? Or did I collect that 40 also by means of denial of deduction? Yeah. Now, I don't need to deny also. I can add this as a, income. It would give the same effect. That's what they say. Either denial of deduction or any equivalent adjustment, like including income or, direct tax charge. So whenever you're calculating, if you are a if you're having a UTPR qualified status, and if you are, calculating your domestic taxes, please also make sure of this adjustment, which will come in your domestic books. Yes, clear? Okay, fantastic. So let's leave there, and we will join tomorrow for the rest of the session. If there is anything on UTPR which you want to discuss, we can take that offline as well. Okay? Yeah. Thank you.